All right, good Monday afternoon, and welcome back to the markets. My name is Seth Golden. Every Monday, we are going over our weekend macro market research report that is delivered Sunday mornings. This will go straight to our YouTube audience. So let's dig in. No rehearsal here. It is late in the trading day. Let's take a quick look at where we are. Markets are under pressure here. We got yields up significantly again, as they were on Friday, but Friday we were able to rally, and a lot of people didn't understand why the market was able to rally last Friday with yields up and the dollar up, because that correlation has usually resulted in negative equity price action all year long. But you have to keep in mind that Friday was weekly options expiration, and we had that tends to be a market operation. We had a goodly amount of overwriting of put options, basically throughout the third quarter into the fourth quarter that we're in right now, which is historically seasonally a positive tailwind for equities. But last Friday being in a weekly options expiration, and yet we had dealers, market makers that had written too many, made markets for too much put activity, and basically it creates this overexposure on the dealer side that they have to get to neutral. The dealers have to get to neutral by the end of the week, and so so many puts were being bought, and the market makers are making markets for all those puts, and now they're overexposed to the downside of the market. In order to get delta neutral, as it's called, they got to start writing a lot of calls. And so it just feeds on itself, regardless of what's going on with respect to intermarket relationships, yields up, the dollar up, and yet the market can go higher under the circumstance where we essentially had dealers too heavily exposed to the short side. They had to square positions, they had to get delta neutral, and so they had to write a lot of call buying activity. And so the market had a pretty robust Friday, up more than 2% in each of the last two Fridays, in fact. All right, something that we talked about here, once again, just kind of reiterate just how bad this year has been and felt like for investors. It's because, whether you're in bonds or stocks, you're taking a beating. That's what happens in high inflation environments. This is the third worst 60-40 portfolio performance of any year, going all the way back to the 1920s. The good news, as always, the following year tends to be very positive. In fact, the next 2 years tend to be very positive. Got down here, next 2 years, very positive. Down here, hopefully the next 2 years, very positive. One of the things that we've also discussed throughout the course of this year is the most tightly correlated analog with 2022's price action has been 1962, almost to a T. And that's what this chart of the Dow Jones Industrial Average shows. It's a layover of this year and 1962. In 1962, we took off to the upside. This is the same, but we're looking at the S&P 500. This chart from the Sentiment Trader discussed the same correlation with the S&P 500 in 1962's performance. The 50-day S&P 500 rallies from a one-year low with correlation of 0.85, which is extremely high correlation. And here is that chart of the 1962 performance. It bottomed on 1022, which was almost a double bottom, and then just took off. Just took off for several years. Very tight correlation with this year's price action in 1962. And why wouldn't it be? I mean, 1962 was a decennial year. That's what any year ending in a 2 is known as a decennial year, which is often also a midterm election year. And lo and behold, this is a midterm election year. Midterm election years suck. So do decennial years for the S&P 500, but they tend to bottom in, well, or retest there in October, and just like 1962 did, take off to the upside. Now, this is the average performance for decennial years. Average. It's not the performance of all the years. It's the average performance of all these years. All right, moving on. Expectations versus reality. Just, investors have to be sensible. We've got to be realistic about how we invest and what we are driving to achieve with our capital investing dollars. A lot of folks, this is their expectation, but then they come to realize this is the reality. There's a lot of up and downs in the market. You're still going up long term. We're getting to the same place, but how we get there tends to be different because the market doesn't go up in a straight line. Really good chart from Brian Feroldi. The best 5 days of the year kicked off last week. Wouldn't you know it, we had a pretty positive week last week. It carries through into this week. We'll get into another really interesting quantitative data point from Larry Williams as we progress through this review. But we also haven't had two Halloweens, two straight Halloween days of trading where the market was down since 2000 and 2001, actually. Unfortunately, it looks like we're going to make that happen here because last year, the market was down on a Halloween day, and it looks like it's going to be. So this is the first time that we've had back-to-back years where the markets were down on Halloween day since 2000 and 2001. Now, this just happened also last week, I believe on Tuesday, October 25th. We had a kind of a breath thrust that fired. Ned Davis Research 3-day price thrust indicator fired last week. It's only a short-term thrust indicator, so got to be aware of the long-term trends. But when this does fire, and here's the details inside of the graphic, thrust occurs when the S&P 500 rises at least 1.5% for one day, at least 1.15% for a second day, and at least 1.5% on the third day. And that happened. It actually goes back to the not last week, but you have to go back to Friday of the previous week. So Friday, then Monday, then Tuesday, it actually fired because you had 1.5, 1.15, and then 1.5% gain. 3-day breath thrust. The good news is if we look out over time, these are all the occurrences here. If we go out, let's say 21 days, a month, more often than not, the market's positive. Number of times up, 8 out of 13. We want a bigger separation. You go out even further, 42 days. So 2 months, 10 of the 13 occasions, the market is higher. 63 days, so 3 months, 11. A year later, the market has never been lower. I would go and check out what the closing price on October 25th was, and recognize that a year later, after this 3-day breath thrust, the market has never been lower. 13 for 13. Did it happen in 2009? Yes, it did. Did it happen in 2002? Yes, it did. So pretty good, for you. What about the great financial crisis? What about the .com and 9/11, folks? It happened back during both of those events, or post those events, if you will. We've talked about the cycle composite index many a times here. We keep in track. The only thing that disrupted this pattern this year was Jackson Hole. I mean, we were trending perfectly. The dash line is the S&P 500. The lighter shaded dash line is the S&P 500 this year. And the composite index itself is the darker trend line. And up to this point in August, right? When was Jackson Hole? Late August. Up to that point, market was tracking it beautifully. The only deviation has been Jackson Hole. It sent us on a much lower path. Nonetheless, while we are still on the same path. Look at this, basing. Then we ran up, pull back here into early November. Well, we're going to hit the first trading day of November tomorrow, folks. So we're just doing it from a lower level. And the reason we're doing it from a lower level is because of the Jackson Hole deviation. If it wasn't for that. And so you have to ask yourself at this point, what could further deviate if there's going to be another deviation? Because if there's not, up and away, right? I mean, it's been tracking it beautifully all year, even now, just from a lower level, right? The cycle composite index takes the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle, right? We've already talked about the decennial cycle. We know it's a midterm year. We know that this is we know because it's taking a 4-year presidential cycle. So we know going into next year, that's the 3rd year of a 4-year presidential cycle. Tells us we know what to expect here this year and in the end of the year going into 2023. So again, what changes this? Maybe we get this little pullback here in early November, but what is going to make that a bigger pullback and not produce this liftoff? Time will tell, as they say, right? Let's see what else we got here. Seasonally, best part, midterm election year. It's going to start right after the election day. In past research reports, we talked about the relevance of looking at the average stock index, which is known as the value line geometric index. We came right back down to 2007 support, which produced 2014-15 resistance, became support again back here in 18-19. And yes, support is sustained even if you break through for a little bit, a month, even 2 months. As long as you get back above it, it's still valid support. Support here in 19 going into 20, and we get right back to that support. So we talked about that, and since then it popped back above it. But we also looked at the relationship or the relative performance ratio of the value line geometric index. Again, that's the average stock and the S&P 500 itself. We noticed that all of a sudden folks were becoming stock pickers, right? Because the performance ratio was trending higher, meaning that the average stock index was beating the S&P 500 off of that September low. For whatever reason, folks were becoming stock pickers. They were picking up at the average stock. And again, here, 542 on the value. This is the updated chart of the value line geometric index. 542, remember, it came down to support at 505, a little bit under 505. It's been trending higher since. Why is this relevant? Risk appetite. We're trying to define, what is the appetite for risk amongst investors, right? Why aren't they just buying index ETFs versus, buying individual stocks? And when we see them buying individual stocks or the average stocks as denoted by the rise from support in the value line geometric index, it gives us a little confidence that this rally can persist. And so, we looked at this a few weeks ago, and this was one of the ways that we determined that the rally could persist, given folks were, picking up individual stocks down there, in the September lows and even in the October lows. We still trended higher, here into October. Right now, this is where we are in the relative performance ratio. What happened coming off of the bottom in 2020? Folks were stock pickers. The XVG or value line geometric index was outperforming the S&P 500. They're finding value in those individual stocks. So the XVG outperformed the index itself. In 2021 is when it started to downtrend. Folks were saying, I'll just buy the index. We'll see how things go. I've already got my core holding for my individual stocks. And you want to see this downtrending long term. But coming out of a bottom, you want to see folks being stock pickers, increasing their risk appetite. And again, that is what we saw. So we got up to, here's the relative performance ratio, doing a little additional technical analysis, looking at, well, where could this have peaked? And it looked like, back here in July, here again in August, September, failed to get to that level, got above it, a clean break above it, checking back. I think we still want to see stock picking. I think that if we are going to see this leg of this new rally that started on October 13th continue, we want to see risk appetite, and we want to see the XVG outperform the S&P 500, at least for a little while longer. Stocks above their 50-day moving average look good, telling you that we actually have 64% of S&P 500 stocks above their 50-day moving average. That's healthy. It's not as high as it was back during that June to August rally where we got over 90%, but this is still a healthy, percentage of stocks trading above their 50-day moving average. Not quite as healthy on the NYSE at 54%, and definitely not healthy for the NASDAQ, only 43%, meaning that less than half of NASDAQ stocks are at or above their 50-day moving average. If you look at the indexes themselves, the S&P closed above its 50-day moving average, but the NASDAQ has not. It has more work to do. NASDAQ is the least healthy when you look under the hood of this rally compared to the other indices. New highs minus new lows. We've talked about this so far as validating, that we might be trending into a new bull market. And while this is looking better, meaning that, we're not making as many new lows, 52-week new lows for individual stocks as we were, back here in late September. And that was probably October 12th, October 13th, right there. We have a good divergence here. Basically only minimal new lows are being found, but the fact is we're still finding more new lows than we are new 52-week highs for individual stocks. Until that changes, you got to be a little cautious or skeptical about these rallies that we've seen now in multiples this year. Moving on to some economic data here. We talked about manufacturing. We may have been wrong about thinking that the manufacturing industry or sector of the economy had bottomed in the Q3 period. I hesitate. I want to see more data for October or even November before suggesting that we were wrong. But a lot of people look at the PMIs and they think that PMIs are a leading indicator. New orders are a leading indicator. And they may lead a lot of other economic data or have a tighter correlation with S&P 500 earnings. Therefore, they have a tighter correlation with the S&P 500 price action itself. But the reality is, and I've shaded this side and peak, these are PMI levels, PMI changes, and the PMI trough timing. In the last column here, let's see, months away from equity market trough or the S&P 500 bottoming, relative to when the PMIs bottom, the purchasing manufacturing indices bottom. And what we recognized is 75% of the time, the S&P 500 bottoms before the PMIs do. I looked at data going back to the 1948-49 recessions, all the way to the 2020 recession. And you only have 1, 2, 3 times did the S&P 500 bottom after PMIs. The majority of the time they bottom before PMIs by a couple of months, 2-3 months. So even if manufacturing gets worse and we see sub 50 prints on the ISM, that doesn't mean the S&P 500 has to go down even more. because the bottom for PMIs may be 1, 2, 3 months in front of us, whereby the S&P 500 historically has bottomed already. Housing data was pretty rough, folks, and it's expected to be. A lot of people are looking at, new home sales, existing home sales, pending home sales, and saying that this is some kind of crash. And don't get me wrong, double-digit declines on a year-over-year basis for any of those housing categories is reason enough to be fearful. What I would say, though, is if looking at this chart here, the U.S. pending home sales index, pending home sales are now down in 10 of the last 11 months. Fed tightening always hurts housing. Why? Because as they raise rates, mortgage rates go up, and there are fewer home buyers that can afford higher rates and higher prices. So the Fed tightening always hurts housing, but smoothing the pandemic's positive, negative effects shows it's not a 2007, 2008 like environment. This is what happened in 2007, 2008. This in the yellow shade is the smoothing average. This is a much steeper drop, folks. This looks more like a reversion to the mean, at least to this point. The pending home sales line looks like crap, but the smoothing average doesn't look as bad because we had this parabolic spike that needs to be smoothed out, rectified, if you will. All right, moving on. The PCE index came out on Friday. Personal consumption and expenditures. A lot of details in the report. You heard a lot of people kind of freak out about, well, we had the wages price index, or the ECI, I think it is. The employment cost index rose, I think it was 1.2% on the headline number in September. But the reality is that's like the smallest quarterly rise in the employment cost index this year. This was the one from the March quarter, 1.4, June 1.3, September 1.2. The pace of wage growth is slowing fairly materially. If we look at all workers, it's only 1.1%. You can see it better here on the Fred's data log here, Q3 of 2022, the employment cost index, total compensation, Q2, essentially all of the bars for their different categories are lower than Q1, Q2. So on a quarter-over-quarter basis, and the Fed knows this, folks, the Fed knows this. Talked about the personal savings rate, right? Because personal savings rate is something that is updated within the PCE data. And it dropped to 3.1%. That's the lowest we've seen even prior to the pandemic. Why aren't folks saving? Well, the reality is they don't have to. They still have like 1.5 to 1.7 trillion in excess savings. It's literally enough to get them through all of next year as inflation comes down, and it is expected to continue to come down. You heard people talk, well, the lower income is, they're still living paycheck to paycheck. No, they're not. They're not. That's not what the data reveals. The Bank of America data from their account holders. Why Bank of America? Because they have the most account holders in North America. So they have the biggest sample size. And as long as you're above 100% here, this is outflows versus inflows into Bank of America account holders. As long as you're above 100%, you're not living paycheck to paycheck. You got more coming in than is going out. All right, earnings not getting better. Well, I mean, they're getting better. The tracking is better for the Q3 period. Right, we went from the FactSet EPS tracking for Q3 of 1.5% year-over-year growth in the prior week to an upwardly revised 2.2% Q3 EPS growth. Right, so they're coming in better than expected. as they usually do, because you've heard it, probably a million times. Well, the analysts ratchet down the estimates going into the quarter, setting a low bar for companies to jump over. Be that as it may, they're still beating the estimates. And so we're seeing upwardly revised tracking for the Q3 earnings period. For the full year, it's getting worse and worse and worse because they're taking into account full year guidance. For finishing last week, the 2022 full year estimate was 222.14. For 2023, which has also been coming down, 238.78. Fast forward to today, because they get updated on Monday. The full year estimates get updated every Monday. So 222 and 238 for 2022 and 2023. Remember those numbers? You got them? All right, good. Fast forward to today, 221 and we'll call it 236. We'll round up. So you see how much that's come down? And this is what people are afraid of so far as next year, right? What if a recession, right? And are we going to finish in the 220s even this year? What if we only finish 218 or so? I'd be willing to bet this is going to come down further even after earnings season. We'll be in the two teens probably. And this will probably be around 231 or so. And then in February of next year, we're dealing with fourth quarter earnings in the rears. So it's hard for a lot of investors to know what should be the valuation I pay for a stock if earnings estimates are coming down for the full year 2022 and 2023. I get it. But as we've discussed many times in the past, earnings, even if they're negative on a year-over-year basis, does not mean the S&P 500 falls. This chart here also begs of investors to rationalize. Like, what do you think the market is pricing in? The S&P 500 earnings are still up here, but down here is the S&P. What do you think the market's pricing in? A lot of that pain has already been taken here in 2022. Also, you've seen this chart before, earnings versus the stock market, 1930 to 2021. And why do we repeat some of these studies? Why do we look at this data, from time to time in duplicate? Because we need to review. We've got to have this running dialogue with how markets function. What is material to the S&P 500's price performance? And sometimes we need refreshers. We need to remind ourselves that just because earnings may go down next year, let's just put that out. Let's say they go down next year. That doesn't necessarily mean the market will go down. Returns are positive 72% of the time when earnings are up year over year, right? That's a good percentage rate. It makes you think that earnings are up. That means the S&P 500 is up, right? Because 72% of the time, that's the connection. But let's say returnings are positive when earnings are down year over year, 77% of the time. It's when earnings are down, the market is actually up more often than when earnings are up. Can you believe that? Again, it just points out, what do you think the market is doing? It's a forward discounting mechanism. What is it discounting? A lot of things. But one of the most crucial things is earnings. It's discounting forward earnings. It almost makes you, you got to look at it twice, right? Is that right? Am I reading that right? But that is the reality, folks. You hear a lot of people talking about stagflation, 1970s recession. Could this be a year where, next year if earnings decline, won't the S&P 500 decline? What if we go into a recession? All of these variables are important to consider. 1973 to 1975, we had a recession. It was a long recession as we fought inflation. We had high unemployment rate. 1974 was the trough, though. It was also the bear killer. I think it was October of 1974, the market bottom. What I highlighted here was earnings in 1970. Here's 1973, when the recession started. Earnings grew from 1972 to 1973. They grew even more in 1974. Yet the market was down some 24, 25% in 1974. When did the earnings recession show up? 1975. The S&P 500 was up nicely. Let's see, 1974, 29 well, it fell 29% in 1974. In 1975, when earnings were down, the S&P 500 rose sharply. I think we was up 20+% in 1975. Same situation from 1981, right? We had the recession, the 81, 82 recession, which was a double dip recession at that. Look at the data, folks. 1981, earnings grew from the prior year. Here's 1982, earnings fell. Earnings fell. The market bottomed in July. July of 1982, the market bottomed. So in month 7, the recession was still ongoing, still battling inflation. The market bottomed in July. It retested, had some degree of a retest in October, and it just took off from there. S&P 500 was up 15% in 1982 when earnings were down. Don't get wrapped up in, well, if earnings, well, if a recession. What's most important is the Fed, whether or not we're going to have a war, and whether or not inflation is falling or rising. U.S. stock market average returns, 1928 to 21. Rising inflation, market generally doesn't do that well. 5.5% average return since 1928. What about falling inflation? Almost 3 times the rate of return when inflation is falling. What about rising rates? Market generally just doesn't care as long as inflation is falling. Why? Because they know what's going to happen to rates. When rates, if inflation is falling, rates are eventually going to fall. So the economy may worsen, but that doesn't mean that the market will, folks. The economy is already growing slowly on a real GDP basis, but on a nominal basis, folks, this economy is extremely robust. Bank of America, Brian Moynihan, the CEO, Brian Moynihan, has been saying, for months now, and most recently last week said, people talk about the economy slowing. We're just not seeing it in the consumption. In the month of October, he's saying that, at the end of September, he said that, their card sale data was up 10%. Double digits, folks. All right. Third year, presidential election cycle, 1931. That's what 2023 is, folks. It's year 3 of a 4-year presidential cycle. Only time we have been down in the third year of a 4-year election cycle was 1931. Talked about the difference between recognizing fund flows as seasonal versus scheduled, right? When you go to work, you go to work. When you're scheduled to go to work, you go to work. Think about 401k allocations. Think about hedge fund redemption periods. When do they start and end? Well, the redemption period for hedge funds ends November 15th. The allocation period for 401ks starts in November. Pension fund rebalancing in November and at the end of the year. So you wonder why the equity markets are so strong in the fourth quarter into the new year? Schedules. This is where capital gets allocated. There's another interesting study from Bank of America, and we'll wind it down from here. What about the technical stuff? You talk about a lot of quantitative data, when this happens and when that happens. What are the S&P 500 forward returns under these different circumstances? What about technically, right? Because the technicals are terrible, right? We've been below the 200-day moving average in the S&P 500. The 40-week moving average for the S&P 500 has been falling, a declining cyclical 40-week moving average, but the 200-week moving average is still uptrending. Well, when those technical dynamics are found in a midterm year, as of the end of Q3, this is where we were, down almost 25%. There's all negative signs here, right? That tells you how bad the technicals are. So we're taking that into consideration, the bad technicals. The fourth quarter, the only time the market was down was 1994, less than 1%. What about fourth quarter of a midterm year into the first quarter of that third year? Market has never been down. 100% positivity rate, percent of the time up, 100% of the time. From Q4 into Q1. What about Q4 into 2Q? 100% of the time positive, 100% of the time positive. Look at the double-digit returns, folks. It's not a big sample size, don't get me wrong, but that just speaks to, here's 1962 again, and there's 1982. By the way, there's the 1990 recession, by the way. So we're looking for similarities. This is a very similar setup with very positive forward S&P 500 return results. I can make a case for the bottom of the market being 3,500, by the way. I'm not saying that was the bottom, but I can make a very strong case. And that's what this chart aims to do. It's taking into consideration the dashed blue lines are implied S&P 500 pathways, assuming the PE multiple moves to its 100, 75, 50, 25, or 0 percentiles. These dashed lines represent the S&P 500 based on the EPS projection, which is based on the ISM. We talked about the PMIs, the Purchasing Manufacturers Indexes, earlier. And people have been saying, well, we're going to get below 50. We may trough out mid 45, 46, 47 range. Well, that's what I'm taking into consideration here. So the dashed line is the EPS. So we're expecting earnings to get worse if the PMIs get worse, if the ISM gets worse. We're expecting earnings, 12-month forward earnings, to get worse. So if it gets to this point, earnings, because the ISM manufacturing index gets worse, that correlation with earnings, we can make the case that at the 20, meaning the multiple for which the S&P 500 has only been at 25% of the time, going back to 1950, that gives you a price of 3,500 on the S&P. ISM gets much worse. Earnings get worse. Even if that happens, we're giving the S&P 500 a multiple of around 17, 17 and a half, which it has produced 25% of the time. You would be at 3,500. What if the ISM bottoms before that level? Right? Well, I wouldn't, worry about that too much. We'd be in good shape, obviously, because earnings wouldn't get that much worse. But more importantly, folks, the market goes down generally when three things are happening. We have rampant inflation, a war, a significant war, or we have a meaningful recession. We only had a mild recession in 90, and we were teetering in 94. We had a mild recession in 2001. We're dealing with this war here in 2022, even though it's not on our soil. Those are really the only reasons why the market generally goes down. It just doesn't go down because earnings go down. When we got to fight inflation, yeah, we're pricing in a lot of bad news, folks, this year in 2022. All right, I hope you enjoyed our macro market research report review, and we'll be back next week.